Okay, raise your hand if this has happened to you. You pay your credit card bill on time, the full balance, not a cent left over. You feel responsible. You feel like you've got your stuff together. And then 2 days later, you check your score, and it dropped 20, 30 points. Gone, for no reason you can find. And you're sitting there like, wait, I did everything right. What just happened? Here's what happened. Your bank is taking a photo of you every single month, and they're doing it at the worst possible moment. Think about it like this. Imagine someone followed you around with a camera, but they only snapped the picture when your hair was messy, your kitchen was a disaster, and you had toothpaste on your shirt. And then they showed that photo to every landlord, every car dealership, every mortgage lender you ever talked to and said, this is who this person is. That's what's happening to your credit score right now. There are 2 dates on your credit card. Everyone knows the first one, the due date, but almost nobody knows the second. And that invisible second date? It's the reason your score keeps dropping even when you're doing everything right. It's the reason banks will never explain this voluntarily, because your confusion is literally making them money. Today, I'm going to show you exactly how this works. Give you the fix. It takes 10 minutes a month. And at the very end, I'm going to show you a dollar amount that's going to make your jaw drop. The cost of not knowing this date is way bigger than you think. So don't skip ahead. Each piece builds on the last. And if you miss the setup, the big move at the end won't hit the same way. Okay, so picture this. It's Saturday. You just bought a couch. $1,200 on your credit card. Smart move. You got cash back and purchase protection. The money's already in your checking account. Couple weeks later, the bill hits your inbox. You pay the full thing. Every penny. Zero interest. You close the app feeling like a responsible adult. Monday morning, you check your credit score, just casually, the way you check the weather, and your stomach flips. It dropped 28 points. No warning, no explanation. And you're sitting there with your coffee going, asking yourself, what did I do? Nothing. You didn't do anything wrong. The system just took your photo on the wrong day. Here's what actually happened. Your credit card has a billing cycle, about 30 days. Let's say it runs from the 1st to the 30th. All month you're swiping. On the 30th, the cycle closes. The bank locks your balance, generates a statement, and snap, takes the photo. Whatever your balance is right, then gets sent to the credit bureaus. But your payment isn't due for another 3 weeks, so you pay it all off on time. Perfect. But the bureau's already got the picture. It says you owe $1,200 on a $2,000 limit. That's 60% utilization. To the algorithm, you look stretched thin, even though you had the cash the whole time. And here's the part that gets me. Your bank knows this. They designed it this way, and they have zero reason to explain it. Because the worse your score looks, the higher the interest rate they can charge you next time. Now, you might be thinking, okay, Clara, so my utilization looks a little high for 1 month. How bad can it really be? Let me show you. Because how much does this actually affect your score, most people never realize. Your FICO score is built from 5 factors. The biggest, 35%, is payment history. Did you pay your bills? Makes sense. But the second biggest? 30%. Nearly a third of your entire score comes down to how much credit you're using at the exact moment the bank takes the photo. Not over time, not on average. Right now, on Snapshot day, think of it like a traffic light. Under 10% utilization, you're green. The algorithm loves you. Between 10 and 30, you're yellow, you're fine. But if you cross 30%, you're red. The algorithm flags you as a risk. And if you cross 50, you look like you're drowning. If you're near 100, your score falls off a cliff. And it checks each card individually. You could have $30,000 in total credit across 4 cards. But if one little card with a $1,000 limit is maxed out, that single card sets off alarm bells, even if your others are at 0. But here's the silver lining. Utilization has no memory. Unlike a missed payment that follows you around for 7 years, utilization resets every single month. One good snapshot completely erases the last bad one, which means you can fix this fast, like this month fast. Quick pause. If things are already clicking, if you're having one of those, oh my god, that's why my score did that moments, smash that like button for me. It helps more people find this. Honestly, this should be taught in school, not buried in fine print. All right, let's get to the fix. Here's the move, and it's almost embarrassingly simple. Instead of paying after the statement shows up, which is what almost everyone does, you pay before the statement is generated. You flip the order. Try to find your statement closing date. I'll show you how in a second. And 3 to 4 days before that date, You log in and pay down your balance to almost nothing. When the cycle closes and the bank takes its snapshot, it sees a tiny balance. That tiny number is what gets reported to the bureaus. Same spending, same total amount paid, completely different credit report. Now, finding that date. This trips people up because your credit card app screams the due date at you. It's right there in big bold letters. But the statement closing date? Buried. Here's what you do. Go to your Statements tab, open a past statement, the actual PDF, and look for the words billing cycle ends or statement closing date. That's your magic number. Put it in your calendar. Set a reminder for 2 to 3 days before. That buffer matters because bank transfers can take a day or two to actually post. On your reminder day, check your balance. Let's say it's $1,200. You want to report maybe $15 or $20, roughly 1% of your limit. So you manually push a payment of $1,180 right then. Don't wait for autopay. Autopay is designed to keep you from being late. It is not designed to optimize your score. You have to take manual control for this part. When the statement closes 2 days later, the bank sees that $15 balance and sends it to the bureaus. Your utilization? Basically zero. Your score? Happy. Then 3 weeks later, on the actual due date, you just pay that remaining $15. Zero interest, maximum score. It's a two-step payment rhythm, and it completely separates your real spending from what gets reported. Now, here's where I need to save you from a mistake I see all the time. And honestly, this is the part most people get backwards. You might be thinking, cool, I'll just pay everything to zero before the statement date. If low is good, zero is perfect, right? Nope. Reporting zero on all your cards every month can actually lower your score. Sounds crazy, but here's the logic. The algorithm is trying to answer one question. Can this person handle debt? If every card shows $0, the model shrugs and goes, I have no idea. There's nothing to evaluate. And no data is slightly worse than good data. It's like handing in a blank resume. You haven't done anything wrong, but you haven't proven you can do anything right either. People with perfect 850 scores don't report zero. They hover between 1% and 7%, just a whisper of activity. So here's the elite version. Pay all your cards to zero before statement day, except one. On that one card, leave $10, a coffee, a subscription. Let the statement show that small amount, then pay it off by the due date, no interest. But the algorithm sees exactly what it wants. Responsible, active, low risk. And suddenly you're just making sure you look good in the photo. Here's what I really need you to understand. This isn't about watching a number go up on an app. This is about what that number unlocks. In real dollars, in your real life. Let's say you're buying a home, a $350,000 mortgage. The difference between a 680 credit score and a 720 score, just 40 points, can change your interest rate by a full percentage point or more. On a 30-year loan, that 1 percentage point costs you over $80,000 in extra interest. $80,000. For the same house, same income, same you, just a different number on a screen. Or let's say you're financing a car. A $30,000 auto loan at 9% versus 5%? That gap is over $4,000 in interest over 5 years. And that 9% rate? That's what you get quoted when your utilization is spiking every month because of a timing problem you didn't even know existed. Credit scores don't just affect loans either. Insurance companies check them, landlords check them, some employers check them. That score follows you into rooms you didn't even know it was invited to. And the wild part? You could fix the utilization piece in 30 days. One billing cycle. That's all it takes to shift the snapshot, move the number, and start qualifying for rates that save you thousands or tens of thousands over your lifetime. This isn't a 5-year project. It's a calendar trick that takes 10 minutes a month. And the return on those 10 minutes might be the best financial move you make all year. Here's what I want you to do tonight, not next week. Tonight, open every credit card app, find the statement's closing date, set a reminder for 3 days before each one. When that reminder goes off, log in, pay your balance down to about 1% of your limit, leave $10 or $20, and pay the rest. When the due date comes, pay that last bit. Done. Try it for 1 month. Watch your score. And when you see that jump, and you will, come back here and drop a comment with how many points you gained. Every comment like that is proof for the next person watching. Your credit score isn't a mystery. It's a photograph. Now you know when the camera clicks. And that's all for today. This is your Clara. I hope you find this video helpful. Make sure you hit the like button and also don't forget to subscribe to our channel for more of these kinds of videos. Thanks for watching.